The next concept is alternative method of production. Okay, this is also one of the important managerial decision that a manager is going to take with the help of marginal costing. Okay, alternative method of production. So here we are going to solve a problem on this particular situation, like alternative methods will be given. We are going to see which alternative method of production is going to be more profitable for the company, or otherwise which is going to be more cost efficient for the company. Okay, so the problem is having the details regarding the manufacturing department. So the average weekly output are as follows. That is, weekly 48,000 output, 48,000 units are produced, and sales value of output is going to be rupees 60,000. Okay, the contribution made by output towards fixed expenses and profit is going to be rupees 24,000. So the director plans to introduce more mechanization into the department at a capital cost of rupees 16,000. So the effect of this will be to reduce the number of employees by 40 employees. Okay, that means 160 employees are there at present. They are actually planning to reduce the number of employees to 120, and by reducing they are also planning to increase the output per individual employees by 60%. Okay, the individual employee output should also be increased by 60% to provide the necessary incentive to achieve the increased output. That means for increased output they should also provide incentives. That incentive is going to be 1% increase in the existing piece work price of rupees 0.10 per article for every 2% increase in average individual output achieved. Okay, that means, so for every 2% means there is 60% increase. There is going to be 60% increase in the individual employee output. So that means for every 2%, that means for 30 times of 1% increase in the price of rupees 0.1. Okay, that is going to be 1% of 0.1 is going to be 0.001, and 30 times of that is going to be 0.03. Okay, that additional incentive is going to be paid for additional work or additional output. And at the same time, as they are planning to increase the sales, they should also planning to reduce the selling price to support that increased sale by 4%. Okay, so they need to reduce the selling price by 4% to increase the sales. So we are exactly here where we need to calculate the extra weekly contribution resulting from the proposed changes and evaluate the worth of that proposed changes. Okay, so we are considering both present and proposed changes information, basic information, and that is, as per the given information, the contribution is 20% for 60,000 rupees of sales value. So because of which the PV ratio is going to be 40% for the present situation, and variable cost ratio, that means PV ratio is 40%, so 1 minus 40% is going to be 60%. So variable cost ratio is 60%, and the number of employees is 160 at present. The proposed plan is 120. Output per employee, that is in terms of units, so 300 output as given in the problem for a present situation. Okay, per employee is 300, and plus 60% of 300 is going to be added. That means about 180 is added. So the output per employee is 480. So this 300 is calculated like this. So the output of the company is 48,000 units, right? So in which there are number of employees that we are going to consider is 160. For each individual employee it is going to be 300. So this is 300. Then there is 60% of increase that they are expecting for each individual employee. So 300 plus 60% of 300 is 180. So total 480 is considered here. Then output considering all the employees, it is going to be 48,000 for present situation, and for 480 output per employee. So for total of 120 employees, the total output is going to be 57,600. Wages per unit as mentioned in the problem, that is 0.1, and for the present situation, so calculation is discussed while discussing the problem itself. So again that calculation shown here. So at present 0.1 is there, so plus 1% increase on 0.1 for every 2% increase in the employee output. So increased output is 60%, divided by 2, you will get 30 times of this value you will get. When you calculate these values, you will get 0.13. So that is wages per unit. Then sales price should be reduced by 4%. This is also mentioned in the problem. So for the present situation, the sales price is going to be 1.25. If you reduce the value by 4%, the proposed sales price is going to be 1.20. Then the variable cost per unit is 0.75 as it is mentioned in the problem. Okay, the variable cost per unit, that is 0.75. This information is also not given in the problem, but we know that the variable cost ratio is 60%. So 60% of sales revenue, that is 60,000, is going to be 36,000, right? So this is 36,000 for total output. For individual output, for individual units, the total output is 48,000, right? 48,000. So you will get 0.75 per unit. So 0.75 per unit. And this variable cost is also going to be increased with 0.03. Increase in wages is going to be added, because wages is also a variable cost. When the wages is increased by 0.03, variable cost is also going to be increased by 0.03. So it is going to be 0.78. So the unit contribution is going to be 0.50 and 0.42. So this unit contribution can be calculated with the help of the above information, or otherwise the unit contribution is calculated like this. Unit total contribution is 24,000 given in the problem, divided by 48,000, you will get 0.50. And for other situation, that is 0.42. Okay, the unit contribution can be calculated like this also. Otherwise, selling price minus variable cost, selling price minus variable cost, you will get the unit contribution. Okay. So the next part is we are preparing a comparative profit statement for both present and proposed situations. So the sales revenue is going to be the total units into selling price 60,000, 69,000. The difference amount is going to be 9,120. Variable cost is calculated like this. So the variable cost is going to be 36,000, 44,928. The difference is 8,928. So weekly contribution is 24,000 and 24,192. The difference is 192. Additional 192 extra weekly contribution is going to be 192 rupees per week. So the annual contribution, annual extra contribution is going to be 9,984. So we are multiplying with the 52 weeks. Okay, for every year there will be complete 52 weeks. For that reason 52 is multiplied here with the weekly contribution. Okay, you will get 9,984. The rate of returns on investment is going to be 9,984 divided by the capital, additional capital that they are putting in. So capital cost, that is 16,000 into 100, you will get 62.4. Here the conclusion is, so we can see that the rate of return on the capital is 62.4, which is very attractive, because the payback period of this particular proposal is going to be 1.6 years only. That means if the proposal is implemented, increases the company's contribution by 192 weekly and 9,984 yearly. So there is yielding of rupees 20, sorry, that is not rupees, that is yielding rate of return on investment is 62.4%. okay, of which is exactly on the investment of rupees 16,000. So the payback is here is calculated, which comes up to 1.6 years. So it is a better plan, or better to implement the proposed scheme if the board wishes to base the decision purely on financial performance. So purely on this financial performance, we can say that the plan is actually profitable for the company.